On December 11, 2025, the Financial Stability Oversight Council, FSOC, released its 2025 annual report. The report signals a significant ideological and operational pivot for the U.S. government from a focus on weakness by merely playing financial defense to a dynamic and fluid offense. Under the leadership of Treasury Secretary Scott Bessent, the Council shifted from a vulnerability-centric approach to one that prioritizes economic growth and deregulation as the primary pillars for future financial stability. The math of that financial stability has changed in a way that enables the U.S. to lead, instead of being lead. The old core philosophy has created a stagnant and over-regulated and inherently fragile economy. The new core philosophy is based upon a growing, efficient economy which builds its own natural defenses along the way. The most important elements of the report can be summarized into 4 strategic shifts and 4 operational priorities. 1. Strategic shifts in oversight. Reframing financial stability, the report recommends a move away from labeling broad sectors as vulnerabilities. Instead, it defines stability as a product of economic security and growth, suggesting that excessive regulation itself can be a risk to the system. Deregulation and burden reduction. For the first time, the FSOC emphasized identifying undue burdens and harmful regulations that may be hindering capital formation and innovation. Restructured framework. The report's structure was overhauled to lead with policy initiatives and economic growth objectives, relegating the discussion of market risks to the later sections. Rescission of climate mandates. Reflecting a broader policy change, the Council and member agencies, such as the OCC and FDIC, moved to withdraw previous guidance on climate-related financial risks, focusing instead on material financial risks. 2. The 4 key priorities for 2026. The FSOC formalized 4 new interagency working groups to manage its 2026 agenda. 1. Market resilience, an emphasis on bolstering the U.S. Treasury market, the world's deepest and most liquid, monitoring short-term funding markets, and enhancing overall market infrastructure resilience. 2. Household resilience, monitoring the financial condition of American households to support economic security and stability. 3. Artificial intelligence, AI, exploring opportunities for AI to strengthen financial system resilience, e.g., in supervision and fraud detection, while assessing potential risks from AI adoption. 4. Crisis preparedness, addressing evolving threats like cyber attacks, disruptions to critical service providers, quantum technology risks, and geopolitical challenges. Underscore 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 underscore. 3. Key findings regarding market health. Although the FSOC noted that the U.S. financial system remained resilient throughout 2025, the shift in strategy is deemed critical to national independence, prosperity, and security. Banking performance. U.S. financial markets and institutions functioned effectively, supporting the flow of credit despite a brief period of volatility in April 2025. Commercial real estate, CRE. The report noted a stabilization in the CRE market, which had been a significant concern in previous years. Short-term funding, payment, clearing, and settlement systems remained operational and resilient under stress. 4. Policy recommendations. Modernizing supervision, encouraging tailored oversight that matches a bank's specific risk profile, particularly for community banks. Non-bank monitoring, continuing to observe developments in digital assets, stablecoins, and non-bank mortgage companies, while seeking more authority for the Federal Housing Finance Agency, FHFA, to monitor third-party service providers. Ending debanking, supporting initiatives to prohibit regulators from using reputational risk to discourage banks from serving specific legal industries or customers. Note, this report reflects a parallel prosperity philosophy, aiming to align the growth of Wall Street and Main Street by reducing regulatory friction.